This video is about the impact of depreciation and changes in expenses or revenues with a replacement project. Those are the two most common changes that you would consider in your incremental cash flows in this type of project. So I've just set up 3 different scenarios to look at and to see the impact. The first one is just a spreadsheet that shows what the cash flows might have been before the project was implemented. And it shows that there was no depreciation at that point, and therefore it would not be subtracted as you're figuring your net income, and it doesn't have an impact on the taxes, which are 40% of your earnings before taxes, and it results in an income of $360 with no additional depreciation. The cash flow is also $360. So the second part of the spreadsheet then is a way to demonstrate what the impact of a change in depreciation will have on the bottom line cash flow. And so we have the same revenues, same expenses, but this time we're assuming that there was a $100 change in depreciation, and it would have been an increase, which would be typical when you are replacing with a newer machine. It would have higher depreciation than anything that you had at present. So subtracting the expenses and the depreciation gives you $500 in earnings before taxes. And in this case, we've assumed 40% tax rate, so 40% of the $500 is $200. Subtract that off, and that leaves you with an income of $300. And to find our cash flow, then we add back the depreciation of $100, leaving us a final cash flow of $400, which is a change of $40 from the previous sample. And so the only impact is the change in taxes that is caused by a change in depreciation. There's no other change in your cash flow because depreciation is non-cash. So to find the impact on your cash flow of a change in depreciation, take the amount of the depreciation change multiplied times the tax rate. The third part of it is what happens when you have a change in expenses or revenue when you replace a machine, which typically you might have an increase in revenue because the machine simply runs better, faster, or whatever other improvement, or you might have a change in lowering your expenses because now you have a newer, more efficient machine, so you have less repairs. So in this case, I simply plugged in that the expenses went from $400 down to $300, and I eliminated depreciation from impacting this at all. So now our earnings before taxes are up by $100 from our original one to $700. Multiply it times 40% is $280 in taxes, leaving us with an income of $420. No depreciation to add back, so our cash flow then becomes $420. So the ultimate change is that it goes from a $360 to a $420, which is equal to whatever change you might have in revenue or expenses times 1 minus the tax rate. In this case, 40%. We subtract that off, and it's 60%. The same result would have been found if the revenue had gone up. So let's make the revenue go up by $100 and return the expenses to $400. And the same result, you end up with a change overall of the $60.